All right, we still have 10.4 million jobs that are going begging in the interim, Dan. And now that might change, to his point. What do you think?
Well, it's an unusual thing, right, Neil? Because you have all these job openings, yet you have people getting laid off. And now, of course, the unemployment rate is going to rise. But you know who's happy about this? The Fed. Because they're turning around saying, hey, it's working, right? We're slowing down demand, so we're going to be able to get supply and demand in line, and then we'll get inflation under control.
But does that mean a soft landing?
Well, you know, I personally think it's too late because, Neil, I think there's no way around the pain here. When you have all these people now getting laid off, to me, that's not a soft landing.
Yeah. You know, because I can look at it, guys, and not to minimize layoffs, but a lot of these businesses we're adding jobs. So we're not back to the point pre the adding of the jobs. So net, they're still up jobs. So you could look at that and say, these are cautionary steps that are taking. Now, they could go beyond this. And maybe in the case of Goldman Sachs, when they laid off better than 3,000 people, I think the big deal there was the bonuses that came out afterwards, and they were fairly paltry. So they're hoping maybe a lot of those people quit. So there could be more of that kind of thing, right?
And look, yeah, and it's logical what they're doing. Wall Street, there's no IPOs, there's no more SPACs, private equity's down, you need less people. Crypto business, that's dead. That's gone by the wayside in a very big way. The mortgage business, which took a big hit, guess what? A lot of mortgage people out. And as you see more and more businesses where things are heading south, there's just going to be less employees. It's the natural law of economics. And when demand picks up again for these areas, when you start to see more IPOs and more deals again, guess what's going to happen? They will hire them back very quickly.
You know, we have an environment, I guess, in a couple of weeks, we expect the Federal Reserve to raise rates, right? I think the betting is a quarter point. I don't know if are both of you in that camp?
Quarter at this juncture.
Yeah. I guess the bigger question is the guidance we get from the Fed and what he telegraphs for future moves. What do you think?
Well, if he stays consistent, Neil, he's going to continue to raise the rate. It may be at a smaller pace, you know, a quarter point instead of a half or 3/4. Right. But again, how long is it going to take to get to the target of 2% inflation based upon?
We're a long way from that.
We really are. Yeah. So again, that's why I'm saying there's still going to be a lot of pain until we wrap this up.
You agree with that?
Unfortunately, I think they're going to keep raising rates, and I think they've already missed the mark. They were behind the curve on the.
So they should have done even more.
No, I think they should stop at this juncture.
Oh, I got you. Okay.
And why do I say that? Just follow the 10-year yield. It just dropped from 4.3 down to under. I think it's just a little under 3.5 here. The market is now screaming weaker economic growth. They don't have to keep pressing the pedal at this juncture. They're going too far on this end, just like they went too far on the other end, and we're slow walking the inflation when interest rates. I mean, literally vertical. For about 6-9 months, and they just sat there and finally played catch up. So the worry is if they go 5%, and we're hearing some of these Fed heads talk 5%, market's going to get hit, economy's going to get in trouble. Why? Because the real market,
5%, you're talking the overnight
on the Fed
lending rate
funds
that they control.
Yeah,
5%, maybe more. Jamie Dimon said could get up to 6%.
Better not.
Better not.
The market is saying otherwise. When you see interest rates come down, the real rates, this is the big institutional crowd buying bonds and rates coming down, it's telling you the economy's going into a little suffer land, and they're still raising rates. I guess the fix their legacy, I don't know what. I just think it's a huge mistake. At this point, do a quarter and then stop, let things be. But I think they're just going to keep doing quarter for the next few, and we'll see how it goes. I'm worried because I think they've been wrong about most things.
Because, I look at these Fed fund futures contracts to that point, and I don't know how reliable they are, Dan, but the latest consensus, always risky, 2 more quarter point hikes, and then they sit out the third 6-week meeting and just see what happens. What do you think of that?
Well, they may very well get to that point, and I would say that the market is probably believing it's going to go in that direction. We're seeing layoffs, so I think investors are saying, oh, look, companies are now reacting and right-sizing to where they should be, being mindful of earnings. Let's make sure we keep that in line. The economy is slowing. That still doesn't mean it's a bad thing for equities. Why, Neil? Because they take their foot off the gas pedal related to interest rates.
Got it.